Hi, my name is Kanal, and welcome to the Geeks of the Valley podcast, which connects with some of the brightest minds globally who are leading their respective industries today to discuss the hottest upcoming industry trends and how their work is affecting the global economy. What started off as a coffee chat has now grown into a global platform for visionaries. This morning from Beijing, we have Ben Harburg, managing partner at MSA Capital, a global investment firm managing over $2 billion. With extensive experience in investment and operations across diverse regions, Ben is a leading figure in the industry. He's also involved in prestigious foundations and serves on various boards. Beyond his professional achievements, Ben is a co-owner of Cádiz Club de Fútbol in La Liga. And today we'll delve into Ben's journey, gaining valuable insights from his innovative perspectives. Ben, thank you so much for joining us today. And how are you over there in Beijing?
Pleasure to be with you, and thanks for having me. All well here in Beijing.
Let's jump into the first question here, shall we?
Go ahead.
Can you tell us about your background and how you first became interested in the field of investment and operations?
Sure. I come from more of an entrepreneurial background. So I started my career as a consultant, as many do, at BCG. And I think I was at the time the only consultant who left my cohort to become an entrepreneur. They kind of laughed at me as I was going out the door. It was not cool like it is today to leave your consulting firm or kind of these really stable career paths and to walk into the unknown. And so I did that, and I left after 2 years as an analyst to start what was a mining and commodities trading company rooted in Southeast Asia. Maybe today that would be the equivalent of you leaving your BCG or McKinsey job to start something in the crypto space, or maybe a year ago. That would have been the case. I started that business, and through some various twists and turns and trials and tribulations, it grew to be one of the largest physical commodity trading companies in Asia, with some of the kind of leading imports of energy products as well as metal ores. And then we built out a full stack product and platform there that included shipping, derivatives, downstream, almost kind of to the power plant or to the smelter mouth, value chain connectivity, and then upstream to the mines themselves across geographies as wide as Africa, South Asia, Southeast Asia, and even into Australia. And then along the way, I started kind of watching the rise of technology. I had a few friends that had gone to Silicon Valley right after college, and I was at college in an interesting time. I went to a school in Boston in 2000, from 2002 to 2006, and that was the same time essentially Mark Zuckerberg was next door, kind of getting his taste for technology, and then ultimately leaving to head out west. And so I had other friends that left or that joined, were relatively early employees at Facebook, or joined various teams at Apple that produced, some of the key technologies that would shape our lives in the coming years, be it the iPhone team or the iPod team or something like that. So I was watching what they were doing, and so along the way, I started taking some of my own capital and investing it in technology, in startups, largely in the United States and some in Asia, kind of as an angel, and also obviously advised these firms to help them think about operations and other ways that I could add value. And then along the way in the commodities trading space, I had set up 4 offices in China, which was our biggest receiver market. And so I was going from Singapore to Beijing and Guangzhou and Shanghai and all over other parts of China on a monthly basis. And I was seeing the rise of these companies that at the time were relatively still unknown by global standards. At that time, we still knew of QQ. We didn't know about WeChat, and Tencent was this cute little name, and no one knew or had a sense of the behemoth that it was or would soon become. And so, I was starting to watch the rise of these companies, and it felt to me that there was this secular trend in China technology growth. And so ultimately in 2015, when an offer presented itself, I sold out of my business and put everything I had and my personal net worth into putting together a firm to invest in Chinese technology, and have been all in on it ever since.
Wow, what a background. And you have significant experience in various regions of the world, including the Middle East, Asia, and Africa. How has this experience kind of influenced your approach to investing and working with companies in these areas, especially at MSA Capital?
We kind of work backwards. So our core focus has always been and will always be China. And that is the market that is the largest. And it's actually pretty hard to go from China to any other market, save for the United States, because when you look at just about any market, including those in Europe, the scale of any one country is about the size of a city in China, or maybe a province at best. And China has this homogeneity of data sets, and everyone being on one communications platform and a couple key commerce platforms. And we have ubiquitous mobile payment, we have ubiquitous low cost, hyper efficient logistics, and all the other things that have enabled China to be a global leader in kind of all the key mobile metrics, be it mobile payment penetration, e-commerce penetration, et cetera. But so we looked at it from the reverse, which was as we scan the world outside of China, and really we started this exercise in 2017, 2018. And of course, I had kind of started in other emerging markets, as you said, and migrated towards China. So I'd started my career in Europe, and then was in the Middle East, and then the commodities time I was in Africa and South Asia, Southeast Asia. So I was already a bit of an emerging market junkie. But as we scanned those markets and kind of thought about them within the context of China technology, it became very glaringly apparent to me in 2018 that China would shape the way that global emerging market consumers engaged with technology. And that, our mantra became that Chinese built, backed, or inspired business models would be those that would shape and dominate the competitive markets and landscapes within the next wave of technology markets. And we were very careful to use this term that we use called emerging technology markets, because many of these markets look very civilized on the surface. They have beautiful gleaming malls and hotels and roads and infrastructure. But the reality is that behind the scenes, in the surface, a lot of their core metrics around those technology adoption, kind of KPIs or data points, still quite low. So low single-digit e-commerce penetration, or low single-digit mobile payment penetration. And so even a market that's quite organized and advanced can actually be lagging in technology adoption. And so, but our thesis was that this next wave of markets would be better informed by the business models, best practices, solved problems that came out of China, more so than those from Silicon Valley. And I'm sure it's no surprise to you, but as you speak with entrepreneurs in Southeast Asia, parts of South Asia, Middle East, Africa, most of them, particularly if they're in a business model that is mobile first, be it mobile first entertainment, mobile first fintech, mobile first e-commerce, mobile first communications, they will tell you, and mobility, they will tell you that their North Star is probably something that came out of China rather than something that came out of Silicon Valley. And that's because the consumers in these markets are engaging with technology and are in an evolutionary state of technology adoption, very reminiscent of what we encountered in China maybe 7, 8 years ago, maybe even a little bit longer time duration. And it's not a similar experience to those of us that grew up in mature markets, and particularly in those like North America. And it's cliche maybe at this point to say, but it's this is what enables this kind of the fact that technology appeared on the scene so suddenly for many of these consumers at a time when they were still so basic in their behavior enabled them to leap rungs on the evolutionary ladder of technology adoption. Is why folks in China went from from wet markets directly to e-commerce, or went from mobile from cash directly to mobile payments, and in a way that those of us in the West couldn't do, because we went through so many intermediary steps and checks and credit cards or big box retail, malls, and all the other sorts of things. And so we saw that same behavior playing out in Southeast Asia, Middle East, Africa. And so we felt that if we understood China intimately, as we do, and have a very deep and wide portfolio in China that covers most of the sectoral leaders in China across the key technology verticals, that then we would have unique insights in how to invest in that next wave of markets. We kind of know what business models made sense, which ones didn't make sense and should be steered away from because they never became profitable or never scaled or tried and tested in China and ultimately never worked. Maybe even Southeast Asia in its laboratory, which is obviously an adjustment on China or an iteration, also didn't work. And then more importantly, post-investment, we could add a lot of value to these companies. We could give them a Chinese playbook, Chinese pre-built technology, connectivity to Chinese businesses. And so we then kind of went around the world looking for markets that fit that set and kind of fit that profile of being able to, fit to that approach of investment and value creation. And maybe not so surprisingly, that ends up being a lot of the world, because it's not just these emerging markets or these emerging technology markets at this point. It's the West, right? It's the West, and it's markets like Europe and the United States and Canada and other parts of North America and today, and you look at the App Store in the United States, and 4 of the 5 top apps are Chinese built, and you start to kind of get this picture that actually anyone who is mobile native is probably more inclined to a bit Chinese built backdoor inspired business model than something that came out of the West for, again, those mobile first products. And so that's what kind of drove us out into the world, out of China, and why we've built now a large global physical footprint across South Asia, Southeast Asia, Middle East, Africa, and even now into Latin America and the United States. That drove us to those markets because we felt like we had unique insights, because we understood China so intimately.
So Ben, you mentioned the Chinese playbook. Could you define that further? What do you mean by the Chinese playbook?
Sure. So it's, what we were referring to is kind of what business models and kind of the technology that enables them worked in China, and might be applicable to an emerging market consumer. So a really simple example would be, the United States still today has been essentially unable to build a super app, kind of one single application that has a huge array of services unified within it. Whereas China has built multiple of these, and maybe let me pick on one of our portfolio companies like Meituan. And so in Meituan, what you have is a company that started as, doing kind of food delivery and restaurant reviews, but ultimately now has expanded across this very wide array of value chain products and services, which include hotel bookings, flight bookings, financial services, mobility solutions, and all kinds of other different kind of e-services, like essentially an e-services super app today, and all in one. Whereas in America, each one of those products is siloed, right? We've got, Open Table for restaurant reviews and restaurant bookings. We've got DoorDash for food delivery, and we've got, Uber for ride hailing. We've got, different financial services applications for those products. We have Expedia for bookings, and no one has really been able to unify all of them. So the beauty of that Meituan model is, I think people were skeptical of it. Even, we faced a lot of skeptical limited partners who didn't believe that this was ever going to be a really big business or could become profitable. But the genius of this model is that you onboard consumers through high frequency, low margin transactions where you're losing money, essentially, say in food delivery, but then you quickly migrate them to other services and products that are higher margin, lower frequency, right? So, when you book a you're a tourist in Shanghai and you want to go to a beautiful temple, you book that ticket on Meituan. It costs Meituan almost nothing for that, right? It's already in the application. They don't, do a huge amount of customer acquisition spend. They don't have a whole team of people. It's a virtual ticketing agency. And so essentially this is a near pure profit transaction, at least at a kind of a gross level for Meituan. And so now that you're in their platform, they're making money, and they became profitable off the back of that exact model. And so then if you extend that to a market like Southeast Asia, and you look at Grab or Gojek, who, while they've had their struggles post-IPO, are still hugely valuable companies and more valuable than any equivalent companies in any other emerging market doing a similar model. You look at them and they have built essentially a replica, and in some ways even more complex, but a replica of these super apps, these e-services super apps in China. And so today both of those companies are essentially banks. They're insurance issuers, but they are, of course, a platform of e-service products, from massages to home cleaning, and of course, mobility and food delivery. And so again, the China playbook kind of instructs you on that, and the Chinese pre-built technology. There are all kinds of applications sitting on the shelf in China collecting dust because they were part of this, battle royale that started with hundreds of competitors in that space and ended with Meituan Dianping and maybe Ulama as the last two kind of true material competitors standing in at least the food delivery space. And so all of that is available and applicable to markets and entrepreneurs who are developing, whose competitive landscapes still offer opportunities for growth. And so that's what we talk about when we think about that playbook and problem solved, because as someone like Meituan was going through that experience of building out a huge platform, they faced all kinds of hurdles. And again, there's now institutional memory and people that can share, that we have in our team or in our kind of expert database, that can share those solved problems, what they did, the workarounds they did to resolve those challenges that they faced as they were encountering them. And so all of that is available today to the entrepreneurs that we invest in. And it's, it's part of our kind of, I think, unique value that we provide to them as we kind of decode, demystify, and frankly, translate literally all of those different learnings into their local languages and into their local contexts.
And speaking of these, Chinese tech giants, how has the rise of these technology giants such as Alibaba and Tencent impacted the venture landscape? And what opportunities and challenges does this present for startups and investors?
It's a great question, and it's an odd one because it's different than other markets, particularly the United States. So many of the large technology giants in America are not so active, particularly at the early stages of the venture capital kind of value chain. And even if they are later stage, often they are more acquisitive than they are minority investors. And so, today, Facebook doesn't really have any kind of a strategic minority investments arm. Apple is famous for never having any kind of an investment fund or arm. Google, of course, has been active, but it's obviously a different kind of approach and more kind of maybe sectorally focused. And of course, Microsoft and others are much more like Apple in the fact that they are more typically, very large investors or majority acquirers, that they want to build, and bring things into their ecosystem rather than just invest in them and leave them independent. That's very different than China, where, Tencent are one of the most active investors, and most of the best technology companies in China will probably see Tencent on their on their cap table, those that have achieved some of the highest valuations. Alibaba also been active, although they do skew a bit more towards acquisitions rather than as a higher volume of kind of minority investments. And Alibaba have been very active globally in acquiring also e-commerce players, be it leaders in Pakistan, Turkey, Indonesia, Southeast Asia, et cetera, and as well as payment businesses that they've built or invested into or acquired in Latin America, South Asia, Southeast Asia. And so these Chinese corporates are not just active in China, they're hugely active globally, and are good investors too, particularly in the case of Tencent. So that creates challenges and opportunities. Certainly on the challenges side, I would say one of the biggest questions that you always have to ask yourself in China, because these Chinese tech giants are so omnipresent, is why couldn't they just put us out of business? Why couldn't they just build this internally and put us out of business very quickly? You have so many different sectors where it feels like there's a monopoly or a duopoly that inhibit new entrants. And so, for instance, we as a firm have not invested in a financial technology company in China in the last 6 years because the Chinese technology giants, particularly Alibaba, tends to have what is seemingly a duopoly, at least in kind of this technology space around around a lot of this financial services use cases, and have, if you look at any of those diagrams of Ant Financial, is just a behemoth when it comes to all the different products and services that they have under their hood. So it makes it harder in many instances to invest or to build businesses in certain sectors. Alternatively, though, of course, we've also benefited as a firm from having those guys in the ecosystem, and many of our portfolio companies have been beneficiaries of receiving significant capital from Tencent, or Alibaba, or ByteDance, or Meituan, or others, Baidu. And also we've had acquisitions. Alibaba's acquired one or two of our companies, Baidu the same. And so it provides us with a nice kind of capital base, as well as a liquidity opportunity for some of our businesses. But we just have to be very careful. It's kind of like being in the grass, being stomped on by giants. We have to be very careful to stay in close contact with them, not fall afoul of them, and ensure we're kind of operating within their same strategic imperatives, and if possible, try to get into somewhere kind of a space that's somehow competitive between the two of them, where maybe you could find yourself in a privileged position of being in the middle of a bidding war or some kind of other form of competition. But critical to not build or invest in anything that is that could easily be that is competitive with them or directly replicable by them, because that will usually end in you having a pretty short lifetime.
And, just diving a bit further into this, right? When it comes to these maybe monopolistic tech giants investing in a founder's startup, the founder has maybe two options if they don't take the investment. Either they be driven out of business by the tech giant, or they be driven out of business by a competitor the tech giant invested in. And so, what are your thoughts in regards to this? Is there an alternative option to this, or is the market that tight?
It's not always a winner-take-all market in China, of course. There are certainly some sectors that see robust competition, but it's hard. And I mean, I'll give you an example. We were investors in the ride-hailing space in Mobike, and Mobike was supported by Tencent. And so that created connectivity for them into the Tencent platform, and made it easier to integrate with WeChat Pay, and Mobike was one of the preloaded applications in the WeChat mini app wallet, without ever having to go and download it independently. And so you could just flip open your QR code reader, scan your bike, and it kind of just took you directly into all the payments and registration without having to kind of go any of that onboarding friction. And so that's obviously one of our competitors was at the time backed by Alibaba, and Meituan had others, and ultimately Meituan actually acquired Mobike, right, as part of that. Going back to my previous point, part of that onboarding engine for their broader kind of higher profitability platform. So probably losing some money on the ride-hailing side or the micromobility side, but making money in all the other services that all those millions of daily users on the bikes then migrate towards. It's hard. You have to be very careful, again, and ensure it's, we work very hard to make sure that we bring in Tencent and others to, whoever's the most kind of applicable technology giant, you want them on your cap table. And Tencent, particularly their investment portfolio, is incredible, right? I mean, Pinduoduo and Neo and all kinds of very valuable technology companies, Meituan, that JD, on and on, that have probably, if you kind of as you've seen, started the process actually selling some of these to kind of remind the world, I think, how valuable all these holdings are, and that as a sum of the parts, they might actually be worth more than people think they are, just given the value of all these stakes. So it's again very tricky, but it's something that we don't kind of, I don't think you face this dynamic anywhere else in the world. And to some degree, it's because China has been relatively lax on the antitrust front and enabled these guys. And I think there have been rumblings about some of these tech giants, losing their freedom to invest so prolifically in the technology space. There was an announcement last year, year before, a year or so ago, that ByteDance were essentially discontinuing their investment arm. Actually, they still have it, but everyone's kind of been reallocated to different departments. So I do think it's probably healthy for the ecosystem that some of that be managed and curbed and allow more for kind of non-corporate funds to continue to do what they do best and help great companies rise without this fear that again, that someone in a monopoly or duopoly position can wipe you out, because that gives them huge negotiating power too. I mean, if a Tencent comes to you and says, we're the only channel on which you can really market because you need to be in our mini app in order to access all the billion plus users we have each day, then you really have to kind of give them any deal they want, and it makes for a challenging position for many entrepreneurs. So I think that's being to some degree more democratized, but not as fast as other countries, obviously.
And speaking of regulation, which you just alluded to right now, can you discuss the role of government policies and shaping the venture landscape in China and how they differ from other markets?
Sure. It's one of the biggest misnomers, I think, when it comes to global understanding of China. There's this perception that China is this command and control market where every aspect is carefully managed and controlled, and it essentially means that you, as an entrepreneur, you are completely kind of at the whim and will of the government. And there have been, in the extreme, for instance, these narratives recently that have been kind of really propagated in Western media, that China government is at war with big technology, and that as a result of that dynamic, the future of China tech isn't so bright because entrepreneurs feel like they could be cracked down upon and are losing kind of light at the end of the tunnel when it comes to being kind of free of government intervention. Generally, and there are exceptions to this, our feeling is quite the opposite on the ground. It's that actually China for the last decade has thrived as a technology market, largely because the government was quite laissez-faire. And in many ways, it was a more law of the jungle, unregulated market on the ground in China than in the West. The simple example would be, again, going back to one of our portfolio companies like Mobike, where if they got kind of one approval for their bikes in a certain province, they were able to kind of use that reciprocally for other provinces, and could, the bikes, as you saw, appeared all over the country seemingly overnight and at massive scale. As opposed to the United States, where someone like Bird, who were kind of the Western equivalent of Mobike, but who are now worth almost nothing today, because they weren't able to plug into a super app like Mobike were, and are just a standalone money losing proposition, that they struggled and kind of had to go county by county, city by city, state by state in order to roll out their bikes or scooters across America. And the joke was that even, I think, in Venice Beach, California, where their headquarters was, they weren't approved for the bikes, or in some intervals were not allowed to. You couldn't obviously get a scooter, I think a Bird scooter, for many different periods in San Francisco, supposedly, so the tech capital of America. So that's just a micro kind of cosm of this. But the simple fact is that actually, if anything, Chinese regulators are now catching up with technology, and they have, most of the actions that have been taken against technology over the last year or so, they've really caught the eye of global investors, were what I would call latent antitrust decisions or regulation that is very much reciprocal of what we see in the West. Any given day, you'll see in a flash in your local business media about Meta or Google or Apple or someone else getting dinged with hundreds, if not billions of dollars of fines from the European regulators and American regulators, largely on anti-monopolistic, antitrust grounds. And this is the same thing the Chinese are going after. I mean, they as we alluded to in the previous questions about the power and kind of the danger of these technology monoliths in China, behemoths. They have amassed huge power, and that power is not just, it's not just as kind of cliche to say a threat to maybe kind of central government, but more so it's a threat to consumers. It's a threat to competition. Consumers lose when monopolies rise, right? A simple example would be, one of the best times the Chinese technology consumer in recent history was probably during the kind of, I'd say, 2015 to 2017 phase, where people like Uber were still in the Chinese market and were competing head to head with the Chinese domestic incumbent like Didi. And because they were competing with each other, there was just a race for who could provide better products and services. And literally the day that the Didi acquisition, or whatever they wanted to call it, merger with Uber was consummated, and as you know, Uber got 20% of Didi and has a board seat on Didi and all these kind of things, but agreed to essentially depart the market. The day that happened, times for waiting for rides went up significantly, so you had to wait longer to get a ride, and prices, of course, went up, and overall kind of quality of service went down. And so consumers lose when monopolies rise, and so the Chinese government, I think, is very rationally trying to take action against a lot of these monopolies, and so that to me is a very rational endeavor. But it's the perception globally, because we're used to a Chinese market that has almost no regulation. The perception is that this is something new and therefore is curbing growth, or is somehow not in line with our Western experience. There are other forms of regulation in China which don't have Western precedent, of course. One being this kind of what I'd call almost like kind of nanny state intervention, where the government feels that certain sectors, while technically legal, are again undermining kind of social harmony, social equilibrium, and where consumers themselves are often, again, the losers at the hands of greed-driven kind of corporates. And so they've stepped in there again in what they believe to be, I think, more of an altruistic intent to protect consumers. So this started with things like China banning the peer-to-peer lending space in China, which was a mess of predatory lenders preying on low-income individuals, offering hugely off-market interest rates, and essentially driving them to desperation and through loan sharking and other things. That industry was largely done away with, and I think to the betterment of society. Gaming, again, another one that's been significantly intervened upon. Again, I don't know if how many parents out there wouldn't mind it if their local government didn't kind of put some kind of a guardrails and a time limit on their children's ability to play PUBG or other violent video games that are hyper addictive. That's what the Chinese government did. Again, they're not alone. We've seen India, we've seen other markets do similar things to reduce that kind of time wastage and addiction, technology addiction amongst particularly young consumers. And then even into sectors like online education, which sounds innocuous while sitting in the West, maybe, but when you came and looked at it on the ground in China, it was this kind of free-for-all of that put immense pressure on parents and students, of constant bombardment with test prep classes and platforms that, again, thrust a lot of parents into debt. There was this kind of peer pressure that you need to put your children in all these different test prep classes that put pressure on the kids. The parents went into debt to pay for these test preps. The test preps were poorly run, with teachers that weren't well credentialed. As a business model, say nothing for the kind of societal harm of the business model. These were also quite bad businesses, I think, quite kind of cash dump business models that burned a lot of venture capital financing and to buy users, but who were not sustainable and were ultimately not, didn't become profitable. It was overall just a very messy industry, and again, not unlike the West, where much of the education system is a non-for-profit. Essentially most of our educational institutions in America are non-for-profits. They kind of push towards a similar trajectory for China, and it's possible they kind of reopen that and find ways to regulate it. But suffice to say, I think that's the kind of one form of regulation that Westerners or foreign investors struggle to understand. But again, for someone sitting on the ground, boots on the ground in Beijing now for the last 7 years, in my case, it doesn't feel that irrational.
When it comes to not being in line with our Western perspective, how have recent geopolitical tensions and trade disputes between China and other countries affected the venture capital landscape in China? And what potential implications could this have for the future?
Sure, it's a very material effect. I studied international relations when I was in university, and actually harbored aspirations one day being a diplomat, and didn't study business as many of my friends and co-conspirators do here. And I thought maybe that would give me a disadvantage because I didn't come from kind of that economic background. It turns out that knowing geopolitics and understanding how the world works and understanding Washington, Beijing ends up being probably the most pertinent skill set that we need to employ in today's world. So I don't. There's a lot of things I can talk about. Maybe I'll just focus on two. One is the ramifications of decoupling on Chinese businesses, and the second would be more the kind of financial aspect of it all. Decoupling and this exercise of separating the supply chains, value chains, capital flows, talent flows, public markets, capital markets, etc., has really had a material impact on kind of reshaping the landscape and what countries and markets do business with China and where Chinese companies can hope to expand and where they can't. One of the key kind of outcomes from a lot of this decoupling is this, what people maybe would what people term splinter net or balkanization of the technology world. And in this kind of splinter net world, you have these parallel ecosystems of Chinese technology companies, be the hardware, software, and the markets where they can go, and similar kind of global, not unlike a global Cold War, where you have different satellite states that are aligned with, with the U.S. and Soviet Union in the old context, and now with China and the U.S. in today's. A lot of this really is coming from the West, and particularly the U.S. in the sense that they have come to a lot of markets and kind of forced them to choose one or the other. But it's accelerated by both sides now, and so some countries now, there's a kind of this, even during the Trump administration time, they use this term clean alliance, clean app store, clean fiber optic cables, clean 5G networks, and it really was this kind of these are the countries and markets that have clean or Western approved 5G networks. And these are the markets that are working with Huawei or other Chinese hardware providers, and maybe similar things on the software side of things. And again, I think that consumers lose in this battle because they're going to be kind of to some degree in a more monopolized environment where you can't have kind of free market competition maybe between Chinese and American technology providers. But also the countries lose, and particularly I think the U.S. loses because China has done an incredible job of accessing that next wave of emerging consumers, as I mentioned on the offset. And if one day America really does choose to pull its operating systems from Chinese hardware and its app store out of Chinese phones and all those, that connectivity to Western built applications or non-Chinese built applications and products, that would mean that those consumers in those markets lose access to, in many instances, the American or the Western built products. And so that means a decline in revenue for the Americans in many of those markets that are really that next alpha wave that will really kind of drive a lot of the kind of true growth for these businesses over the coming years. And instead they'll be left with operating systems built by Chinese firms and app stores that connect you to Chinese built applications. And so it's to some degree to America's detriment to withdraw from these markets or these operating systems or this hardware or force countries to choose. And I think consumers and companies are better when there's competition, and it keeps It keeps, kind of, again, consumers protected. It helps, kind of this concept of iron sharpens iron. It helps keep everyone honest, and also keeps everyone pushing towards higher degrees of innovation because they have to kind of compete openly. So decoupling is starting to kind of draw a new map of the world along those lines, which is something you have to bake in when you think about the growth potential for certain Chinese or American technology, as well as the type of capital and talent and other kind of key inputs that technology will have access to. And that kind of goes to my second point, which is, that there is a very material wave of decoupling actions being taken largely from the West today again. And these have a really significant impact on the Chinese technology landscape. So the first were the kind of withdrawals of hardware, be it chips, software, and machinery that were driving in the development of some of the Chinese core technology companies, chip companies, AI application businesses. So the loss of that hardware and software is material, and it means that it'll slow down some of the kind of growth trajectory, at least in the short term, for these Chinese businesses. And we have companies in our portfolio that will see an effect from that. The other one is obviously even more material to my mind, which is the capital side of things. We've been talking about it, and I've been warning our investors for almost a year now. It's on the way, but there will be a coming capital ban announced imminently from the U.S. side about certain sectors in China, where they will restrict flow of U.S. domiciled investor capital into those sectors. And so that will mean less capital available for Chinese startups as they look to build. And there's a broader kind of halo effect of that, which is today, given again all the kind of constant geopolitical narrative and noise in Washington, and of course, the challenging kind of conditions that China has presented the world with over the last few years around zero COVID and some of the things that control domestically, the actions taken domestically, that many Western investors, at least today, are shying away from the Chinese market when it comes to investing in funds or direct investments into companies. And so that means that there's materially less available capital today than there was a few years ago for the China market. And so that means that companies have to be more cash conscious. They have to be more thoughtful about from who they raise, and making sure these are companies or these are funds that have, kind of strong and long-term capital partners. They have to find other alternative domestic sources of capital, R&B funding, state funds. And of course, there's a lot of Chinese government and regulatory support around these sectors today, but they need to find a way to access that. And so it just really kind of has reshaped the capital landscape in China in ways that I think are ultimately detrimental to Chinese entrepreneurs and growth, because there isn't just as much capital available today as there was historically, or the growth rates aren't where we thought they would be today. And so that has a overall ecosystem effect, and it means companies have to be a lot more strong on fundamentals. And that's why I think it's unlikely we see a lot of next generation of ByteDances or Pinduoduos or any of the kind of $100 billion plus type companies that came out of the last cycle of technology kind of innovation in China, because those required really significant resources to be built. And there's just a lot less money today available to founders that are using money to buy market share or to spend on customer acquisition. And so we as a firm have always stuck to companies and entrepreneurs that we felt had significant technological moats around their business and were very defensible and didn't burn to kind of gain market share. And lo and behold, that ends up being probably the ones that will survive this current challenging period while capital is constrained. But it's a material impact on the venture ecosystem.
And Ben, I know we touched on this in the conversation previously in pockets, but can you speak to the unique characteristics of Chinese venture capital firms and how they differ from those in other markets, particularly in terms of investment strategies and portfolio management?
It's a good question, and I'm a weird bird in the sense that I'm American, but I've never worked in America, and so I do I spend a lot of time with venture capitalists in the U.S., but I've never been a practicing venture capitalist myself in the United States, although we've made certainly some investments in the U.S. it's a different market, but not wholly different. I mean, it feels to me a bit more cutthroat, bit more dog eat dog. Again, going back to that law of the jungle analogy I used previously, it really does feel like that competitive fire and intensity in China that we faced was to a degree more intense than I'd seen anywhere else in the world. In the competition for deals and the types of things we saw VCs doing and investors doing to kind of see if they could ward people off of companies or out of rounds. But from a so that's just kind of behaviorally. But I mean, from a sectoral perspective, there are quite some large differences between China and the U.S. today. So again, fintech in America remains a pretty interesting sector to invest. Essentially, nothing of that sort really available in China today. SaaS has been a sector that has been rumored to be in, kind of quite hot or sorry, SaaS is a sector that is quite robust in the US, but it's always been kind of on the cusp in China. There's always been this rumor that it'll be the next big thing, and people pitch around it and talk to it, but there's still relatively few SaaS companies being built in China today that are what we're accustomed to in the US, the Cisco's and SAP's and Oracle's of equivalents or Salesforce equivalents, and for various reasons. And so, where China is today, because a lot of that consumer opportunity feels pretty well saturated. And again, while in America, you're still seeing investments in the consumer space where people think they can still build new social networks or new e-commerce platforms or creator kind of platforms that provide tools or communication channels for this next generation of content creators who are really kind of supplanting traditional advertising or other marketing channels. Again, a lot of that feels very well covered and saturated in China because of the domestic incumbents in those spaces: Pinduoduos, Alibaba's, ByteDance's, Tencent's. And so what that means is in China today, the sectors in which we can invest are maybe a little bit more constrained, and it's more in the spaces that I think China significantly lags the West. And so that's kind of biotechnology and life sciences, where China has historically struggled to build domestic businesses that have global applicability and can kind of reach those tens, if not hundreds of billions of dollars in valuation. We have very few of those in China today. And likewise in the core technology space, again, where China historically was more dependent on US inputs. And so, the likes of Xiaomi could build a really beautiful front end and an ecosystem behind it of products and services, again, a super app of sorts that had a hardware kind of onboarding ramp. But they didn't do the hard part, which was the core technology. They kind of relied on Western built operating system, Western built chips, and even app stores, of course. And today, given the geopolitical context, they're having to, kind of be more self-reliant in those spaces. And so that's generated a whole new set of interesting core technology opportunities, again, ranging from chips and quantum computing to AI applications to space tech, to aerospace and anything kind of that now China's going to have to develop on its own, and where investment into Western equivalents is probably has been restricted for several years now. So those are probably the spaces that I think are the most active today. And then of course, so the consumer space, we still invest as a firm into companies that we think have a very high technical moat, or are part of this kind of China to the world narrative. So kind of that long tail that sits behind Shein and TikTok and others that are Chinese companies that follow that formula of using a Chinese business model to address global consumers.
And coming from this global consumer perspective, how are Chinese startups and investors adapting to the changing global landscape and increasing competition from other markets, particularly in areas such as blockchain and AI?
So, Chinese firms historically weren't that global in the venture space. We're probably one of the most global kind of, firms that had a presence both in China as well as in other markets. And we're one of the, probably the most global in the sense of one that's kind of was started in China, but then expanded outward. Uh, and so I don't think that Chinese funds have too much, because and capital has been constrained in the sense that the Chinese balked a lot of these outbound investments back in 2017, and thereafter the Americans also blocked a lot of Chinese investments into the West through CFIUS and other programs. And so the Chinese have been in a bit of a walled garden ever since. Obviously, they were also essentially kicked out of India. And so there were very few markets for them to invest in outside of China. And again, there was always this kind of attitude that China was um, such a large market that you didn't need to look beyond its borders too much. I think some of that is changing, but I would say generally that Chinese VCs are more myopic than their Western competitors who are investing, in Latin America and maybe in Africa and Asia and elsewhere, where the Chinese are much more home bias focused. And beyond that, I think in the verticals that you mentioned, crypto is an interesting one. Obviously, I think China had a pretty unique lead in the space, and a lot of the kind of key engineering talent and founders that are now shaping the crypto world globally started in China, but because of a decision taken by so China had kind of head start, I think, to some degree, because of these decisions taken from Chinese regulators around the industry. Most of those folks either discontinued their efforts or left the country and are now living in Southeast Asia, Middle East, North America, Japan, or elsewhere. Um, and um, and so there's still some connectivity, and we've certainly seen a few Chinese funds that invest in both Chinese entrepreneurs building the crypto space that are based elsewhere, and that obviously then led them and opened doors to other crypto products built by other entrepreneurs from those home markets. But overall, it's a space that we've seen, I think, less activity and maybe less success than again many of the Western counterparts, just because of that divide, and that also again all of this happening within the COVID context. So there was a physical divide that stopped a lot of these Chinese firms from being able to see and work with those companies overseas. There's certainly a huge amount of exuberance for the space in China, and I think with the door opening, you'll see more there. But obviously now that sector is in a bit of a downturn, and so again the question will be if it's the right place for these VC funds to put the precious dollars, or another kind of more stable business models that kind of fill those market gaps that I mentioned back in China. And then in the AI space, again, I think there's this huge craze underway in the West, and we're seeing still kind of off-market valuations being achieved even while we're in kind of a recession of all sorts in the West, and we're seeing similar things in kind of a parallel universe in China. Similar kind of valuations, similar exuberance, some of it irrational in the space. So one needs to be very careful today to kind of think about who to work with and where to enter, and whether to sit back and wait for some more proof in the pudding before jumping in. But suffice to say, China is having its own AI, ChatGPT craze, and how that filters into all kinds of different commercial applications. But again, in kind of a walled garden parallel universe, rather than a lot of Chinese capital flowing into Western companies doing these models.
And Ben, to wrap up our call with our last question for the day. As a co-owner of a football team in Spain's top division, can you share with us how your passion for the sport has impacted your career and personal life?
Well, it's really easy. I mean, I bought into this team a few years ago with the thesis that we had already tapped out our kind of regional market when it came to sponsors and kind of revenue penetration, and that the best way for us to increase our revenue, and therefore and revenue is everything for us in these teams. It's our money buys players help us stabilize our position in the league and hope ultimately grow and play for the ability to compete in European competitions and and other kind of lucrative TV kind of products. The way I determined that we would do that, amongst other initiatives, but the one that I could add the most value to your question about my own background, is through globalizing the team. And so I set on a mission to bring this team to the world in a way that very few others had done to date within our league. You've seen some of these initiatives that have come on since then, like Welcome to Wrexham and some of these other ones where a celebrity was able to kind of introduce an unknown team or relatively unknown team to global audiences. We did so without the benefit of celebrity, but we did so in a very methodic and systematic way, and that was in many ways actually to mirror the global footprint that I have in my investment portfolio, to use that to enable us to plug into partners in all the markets in which I operate. And so, for instance, the typical progression for us would be to form brother club partnerships with maybe the top team in each geography in which we operate. And then off the back of that, we would build a social media team, building localized content for that geography in the local language, in the local style, local memes. And so enable us to kind of introduce our product and team to a whole new set of fans. And then ultimately to seek kind of club tours, so bringing our team to Southeast Asia to play against all of our partners in Southeast Asia, the Middle East, play our Middle Eastern partners, or China to play our Chinese partners. And then, of course, off the back of that, generate new content partnerships and relationships, so shows or their sponsored products, as well as just general kind of traditional sponsors that would show up in our jersey or our stadium. And so it's been really fun because it enables me to kind of, without too much effort and going too far beyond what I'm doing day to day, to kind of bring it along with me. And it provides a nice kind of point of conversation and something that we can, plug our existing partners and friends into as well. And we've even had, some of the technology companies in our ecosystem become sponsors to the team. But we've done it, leveraging what we've, really understand on the technology side, which are the, unique aspects of global social media. And I've built these, as I mentioned, localized social media teams around the world. So it kind of enables me to fuse my day-to-day work in technology and investing across multiple geographies with this, what is a childhood passion for this sport that is, unequivocally the most watched, the most important sport to fans across the world. And so it offers a great kind of point of connectivity as we go to new markets, and it also, provides a nice synergy. So globalizing that team has been one of my great joys, and it's every week one of my pains and joys to watch our games and watch all of our hard work put on the line, and hopefully continue to pay off as we grow the strategy going forward.
And Ben, for people out there who are interested in catching a cup of coffee with you or pitching their startup idea, what would be the best point of contact?
Just go to my website. It's just benharburg.com. We have all of those components you just made, all those different, the pitch section. We have a communication section. So anyone who wants to reach out, please feel free to. And if there's something we might be able to work on together, we'll get back to you.
Ben, it was a pleasure having you on Geeks of the Valley, and thank you so much for joining us today.
My pleasure. Thanks for having me.